2010, she saw the central bank through the challenging days of the Lehman crisis. She worked her way up at the RBI, starting from the dealing room in 1991, and also did valuable work on financial inclusion, including her tenure at the central bank. She also takes active interest in social issues. She's a trustee at the Indian Cancer Society. Please give a warm welcome to Ms. Usha Thorat.
Ladies and gentlemen, great pleasure to be here this evening. Thank you, Lata, for inviting me. Thanks to Moneycontrol for the invitation. Thank you, Mr. Barua. It's been such a journey you've taken us through, and I don't think anyone other than you could have summarized the entire gamut of regulations in such a concise, logical manner that I thought for myself it was really an educative experience. Thank you so much. I find the panel discussions are really well structured and well thought out, and I'm sure there's going to be a lot of very, very exciting and interesting. I look forward to the industry expressing its views very frankly and freely, and in the interest of investors and the industry. My understanding of this industry is very recent, and I can't claim any expertise or experience. But what I have seen in the last few years is very remarkable. Mr. Barua had summarized a lot of these years, but it has been a very, very eventful period. And what we have seen is this phenomenal growth in the assets under management. The post-COVID years, awash with liquidity and lower interest rates, facilitated by digitization, has seen a phenomenal growth of investors in the mutual funds, as also in the assets under management. The Reserve Bank quarterly data on household savings shows that the assets under management grew at bank deposits grew at 9.4% in the last 2 years, and insurance by 6.2%. Household investments in mutual funds actually grew at a CAGR of 32.3%. Mind you, this is not the growth in total assets under management of mutual funds, because that includes, that 40 lakh crore includes institutional investors. What I am talking about is just the individual investors. So the total assets under management, like we saw, it's a 40 trillion industry. The household investments constitute about half of that, 21 lakh crores. So this is remarkable indeed, and it is in the right direction of garnering more funds from households, rather than from institutions and corporates who are actually informed investors, and maybe they ought to be investing directly in the markets. The phenomenal growth also implies that the fiduciary responsibility of all of us is getting more and more important from the system's point of view, and this is something that we need to be responsible for and constantly aware of. SEBI and AMFI have taken a number of measures, and Mr. Barua has really gone through that, especially since the ILFS 2018 and then March 20 issues, making sure there's greater transparency to the investor, funds are not taking risk beyond the mandate of the investor, and there is a greater degree of risk management, and that their interests are aligned with those of the unit holders and conflicts of interest are avoided. Measures to deal with market-wide disruption and stress have also been initiated. And the earlier period was more a period that was sort of focused on changing the incentive structure that favored an upfront and a distributor-driven system to one that was focused on investor interest. But the last 5 years has been really on the issues that Mr. Barua. So I don't want to go through some of those issues which I have, but I think one issue which is definitely important is also on the voting by mutual funds, because they are becoming bigger and bigger holders in the corporate equity, and I think their role in the voting, I think, is important, and on that too SEBI had issued some guidelines. Now, we think of mutual funds as pass-through structures, where the investor who does not want to invest in the market directly gives a mandate to the fund manager to invest according to her risk preference, and then is prepared to take the losses and gains as long as the mandate has been complied with. The investor also expects redemption when he chooses to exit the fund. And there have been anxious moments for mutual fund investors. We saw this, like Mr. Barua says, in 2008 we saw it. We saw it in 2013, and we saw it again in 2020. All-round drop in market liquidity, especially for bonds, creates the redemption pressure, net NAVs drop, triggering further redemption. So much so that even very highly rated assets did not seem to have an exit route for their, for them. And usually this happens when there is an overall crisis in the system, and what typically happens is that there's a huge pumping in of liquidity and to create confidence and prevent a spiraling downturn. So in a way, I would say that what has happened, and this is not true only in India, but also the entire world, that it's sort of the regulator's intervention seems to have become a costless option, writing a costless put option. And it is in this context I want to raise the first issue. Should we be looking at a roadmap for gradual exit of institutional investors from the mutual fund industry? I'm sure this is not at all welcomed by many of my friends from the industry. But when you see that mutual fund penetration is just 10% of household savings, there is clearly a need to focus on mobilizing more and more of those financial savings of households, whether it is in tier 1, tier 2, B30 or whatever it is. And therefore, we cannot be complacent just on the basis of the size of the AUM. I think the AMFI mutual fund Sahi Hai awareness scheme and the encouraging the B30, it's had good results. But there need to be incentives, and not incentives which get misused, for mobilization of retail investors. Institutional investors, I'm sure, provide liquidity. There are also lots of pluses, I'm sure, of having institutional investors. But they're also the ones who pull out normally in the moment of any information, and the retail investors are left behind. Thank God this swing price that you, Mr. Barua, referred to actually makes that, the kind of implication of that for those left behind a little better. And when there is a crisis, the measures, so in a way, life becomes very cushy for institutional investors. So whether we should really be looking at this kind of a roadmap is what my first question is. Now, ETFs and index funds are actually ideal for retail investors. The total assets in such funds has grown significantly in the last 5 years, in a multiple of 10 in general, and for individuals, it is a multiple of 15. Also, the AMCs are permitted to, while they're permitted to charge up to 1%, the actual expense that is being charged is as low as sometimes just 0.1 or 0.09%. But at the same time, these products do not seem to be, they have certain shortcomings. Maybe the pricing, there's a gap between the pricing and the NAV. There is a poor secondary market liquidity. And I think industry leaders, like all of you, have to somehow see that the infirmities in these markets and the way that retail investors come into those markets can be really increased. A second is a connected point, and this also Mr. Barua left to, is whether when we look at this two measures that have been announced, one is about the backstop facility, which will create a body which will both purchase investment-grade securities, both in stress times and normal times. And the other one is the setting up of the AMC Repo Clearing Limited to boost the liquidity in the bond markets and, in a way, really helping the mutual funds with the needed support. These two market microstructure measures, it's hoped, will become operational soon and can help the markets when under stress, particularly when the mutual funds are struggling to redeem. Now, these are all extraordinary interventions on ground of public policy. So whether they should really be available to institutional investors, which is inevitable because they are all part of the mutual funds, or it should be to the retail investors. The third issue, and this is something that Mr. Barua, in fact, very clearly brought out, that when the regulations were started, a mutual fund is established in the form of a trust. It is a three-tier structure. There is a sponsor who forms the trustee company. the asset management company. The trustee holds the assets of the mutual fund in fiduciary capacity, and the asset management company is responsible for managing the funds in line with the stated investment objectives. At that time, as I understand, consideration was given to two major factors. One, that mutual funds are garnering a large amount of money from the public in a dynamic market. This required specialization on the persons performing the functions, reducing the cost, and also ensuring potential conflict of interest is avoided by ensuring an arm's length relationship between the various functions. So this is, the three functions are there, but the primary responsibility for the oversight is that of the trustee. And it is in this context I have been sort of thinking whether there is a need now to have a better clarity on the role and responsibilities of the sponsor, of the trustee company, and the asset management company, so that the accountability for any wrongdoing or any violation can be clearly laid at the floor, at the instance of any particular entity. One is, of course, overlaps, the other is gaps, and also the question of overburdening these entities with so much that do they lose their focus. So I think this is a matter on which I feel that a summit like this is something which can look at it. So there is the role and responsibility of the sponsor. Now there are huge variations in also this, because it depends on the nature and the size of the sponsor. The largest mutual funds, and many are here, are invariably sponsored by large financial conglomerates with deep pockets. There is merit in this, because in terms of financial resources and in terms of talent, sponsors are able to give the needed support to the AMC and even provide them with liquidity in stress times. From the investor's point of view, it's a holding out. The holding out by such sponsor, even without legal liability, it provides huge comfort. And many retail investors sometimes actually feel that the name which is going with the mutual fund gives them a lot of confidence. And so they feel it is like as good as investing in the bank itself. So from the regulator's point of view, and I'm taking a little aside now and getting into the financial regulator for the system, so let me digress a little bit, I hope you don't mind, that there is a holding out risk, all said and done. And this is called, in Basel terms, a step-in risk. So how do they define it? It arises to avoid the reputational risk that a group might suffer were it not to provide support to an unconsolidated entity facing a stress situation. There is a framework under what is called the Financial Conglomerate Supervision Framework, where such risks are expected to be monitored, such risks expected to be addressed. It is a financial stability issue and will be probably the FSDC is the most appropriate forum. But I'm linking it here because it's linked to the role of the sponsor. So come back to the role of the sponsor. Sponsors have, in many cases, divested a good bit of their holdings. They're independently listed on the exchanges. So should we really de-link the AMC with the sponsor? And the sponsor's role and responsibility taken on by the AMC itself. From the system's point of view, the investor will rely on the transparency that is available, and there'll be probably more level playing field vis-a-vis smaller funds who don't have a big name behind them. Anyway, there are pros and cons, and I think this is something that is constantly discussed, and it probably needs much more debate. Next, let's turn to the role of the trustee company and the role of the AMC. The trustee's primary responsibility is to have oversight, to ensure the funds is invested as per mandate and true to label. Now, possible conflicts of interest are disclosed and addressed. And I would say that in financial sector behavior and regulation, the thing that really triggers problem is usually conflicts of interest. Now, where conflicts of interest will come from and how you will start monitoring them and looking at them cannot be laid down in any manual or rule book. It is something that it's the role of the independent directors, both on the asset management companies as also the trustees, to really ask the right kind of questions that possible sources of conflict of interest are, brought out and addressed. So clearly, when having the trustee structure, it provides an oversight. It acts as supervisors, like you said, first-level supervisors, and it also monitors the compliance and ensures the investors. The opposite way is that there is a lack of financial and operational independence, and that could hinder efficient discharge of duties. Main way that independence is being ensured is through having that independent directors and having one person exclusively to attend to and that was also something quite recent, to the trust company who will be giving all the information. So, but then there can be situations where they could be, they may not be the kind of independence that we are really looking for. In the case of the AMCs, the basic responsibility to see that it's compliance. It is to see that the funds are invested according to the mandate, there is true to label, there is full transparency, valuation is done as per the guidelines, and having a dynamic, evolving risk management strategy. That, I think, is something that Mr. Barua, in fact, clearly articulated the various risks at the level of the AMC and at the level of the scheme. So, while reviewing these role and responsibility, I think what I'm trying to say is that we have to have clarity about the accountability without undue overlaps and gaps, freeing the trustee of many of the operational and compliance functions that can be done on the basis of assurances, and making the trustee focus on its main role, and also making sure the AMC, is strengthened to take on this role of, in the eventuality the sponsor not being there, and also many of the things which is currently we are expecting the trustees to do. This can also reduce the oversight, the cost of oversight and compliance. Of course, like I said, it will call for highly professional and independent directors who can smell the sources of risks. I have been suggesting that maybe we should have periodic conference of independent directors of trustees who can really, get together and discuss issues of current concern. A fourth issue, of course, it's continuing with the conflicts of interest. There are cases where the possibility of conflict of interest is more, especially when the AMC is part of a larger financial conglomerate, which has a bank, an insurance company, a merchant bank, other financial entities in the same group. It should not happen that the investor, that is the unit holder, is pressurized into acquiring assets through the AMC where there could be pressure by the group companies. It could happen when mutual funds are invested, could happen where, in particular, where mutual funds are investing in the primary market, in public issues or in privately placed debt securities, where the merchant banker, there could be possible pressure. There could be situations where a near default but rated security is passed on to the fund. So can we call this mis-selling? Can we call this conflicts of interest? What do we call it? We have also seen sometimes at a retail level, you walk into a bank branch wanting to make a deposit, you come out either with an insurance or a mutual fund policy. So, these are some things that is inevitably a part of this cross-selling kind of a business. A final point which I want to make is the objective of regulation and the manner in which rules and regulations are interpreted and enforced. Apart from the fact that there should be a clear accountability and the right person is penalized, one cannot be quibbling with the wording of the regulation when it's very clear that the investor's interest has been clearly compromised. When wrongdoers are punished and regulators has the authority to do so, after establishing that the investor's interests were compromised, needless litigation appeals only go to weaken the regulation. And I think as a system, we have to be very conscious of this. And we sometimes end up generating more and more regulation. more rules are written to address those very infirmities which were challenged. This is not productive at all. So we have to very often we tend to forget that regulation is useless unless there is adequate supervision and ability to enforce. It is that enforcement which is actually going to make the system safer. It will, if we all act in that spirit of regulation, the cost of regulation to society will be much less. Thank you all very much.